Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. I also want to give a huge shout out to the members of the Cash Flow Club. Thanks, guys. I really appreciate that. You can check out the website, cashflowinvestingpro.com. This week up, we're going to take a look at HP, the behemoth in the printer and computer manufacturing company. Warren Buffett just recently took a large stake. Let's figure out how much hard cash money this stock makes. And if we bought it today and held it for a decade, how much return would we make on our money if we did that? You ready? Let's get to work. Okay, behind me is the 9 years of historical financial information for HP. Before we dive into that, I want to review the 5 key attributes that we use in this channel to value or to qualify all securities. Number 1, top line revenue growth. It's got to be growing. We want revenue growing. Number 2, earnings growth. At EBITDA enterprise level, earnings must be growing. Number 3, strong cash flow. Number 4, low debt. And number 5, well priced. What is a well-priced stock? A well-priced stock is a stock with a conservative growth forecast, which return profile beats the market. That's it. I want a very simple, easy growth forecast and a expected return to be above 10%, which is the S&P 500's average 10-year return. So behind me is the other financials for HP. Now, one caveat here. HP split itself, right? So you had HP as a giant conglomerate in 13 and 14, and then in 2015 they broke the company up and split it. HPQ, which is what we have here, it's called HP Inc. now, not Hewlett Packard. That's the lion's share of the company. The printers, the computers, all that manufacturing and sales is in this company. The the server business got farmed out to a different company. HPE is the ticker in that one, but this is HPQ. So let's take a look at 9 years of financial information. And you can see back when they were combined, they were $112 billion of revenue top line, and then they split and it cut down. So what we're going to do is we're going to look at the business kind of from this post-split going forward to see what the business has been doing since the split. So all these numbers down at the bottom, the CAGRs or averages, are going to be 5-year averages. Basically, once the dust settled from the split, what have they been doing from there? So just to review, revenue drops, but then from there it starts growing again, which is nice and what we want to see. And when I look at these years here, annualized rate is a 6% annual growth rate, which is a nice, solid, mid-single-digit top-line revenue growth for a mature business. We like that. That's going to check the box for us on revenue growth. When we look at EBITDA, now EBITDA, earnings before interest, tax, depreciation, and amortization. That is our proxy for cash flow. That is on the income statement. It's a poor proxy because there's no CAPEX, and we will look at cash flow, pure cash, in a second. But when I'm looking at the income statement, I want to look at operating profit or EBITDA as a judge for profitability. I do not look at earnings per share because earnings per share can be distorted by the number of shares outstanding. We want to look at the enterprise as a whole. We want to make sure the enterprise itself can grow earnings. Then we look at per share basis. So on an enterprise level basis, $4.2 billion of earnings has grown to $6.6 billion. Now, this is a COVID spike for sure, but it is nice to see a growth rate here over time. If I look at this, kind of averaging these and averaging those, it's about a 6% annualized growth rate, which means margins are being consistent and revenue and earnings are both growing. Good job, HP. Let's look at enterprise value and see where this business stacks up. Now, enterprise value, for those of you that are new to the channel, enterprise value is what we look at. That's not market cap, it's enterprise. It's the entire business. If you think of buying a house, for an example, and you want to go and buy the house, the market price is the enterprise value. You then go to a bank and get a loan, which takes down some of the money, the equity that you have to put in, and then you have your equity principal. A combination of debt and equity is the enterprise value. And for publicly traded stocks, it's critical, absolutely critical, that you look at the entire value of the business, the enterprise value. The stock that trades in the stock market is only the equity, it's only the market cap. And if you look at a business that has the same stock price, but one is much more levered than the other, there's a difference in valuation between those two. So you always want to look at enterprise value. Now, what we're looking at here is $20 billion of debt back before they split. Then they split off and you see the debt drop significantly. So the business profile changed dramatically when they did that. And from here, debt is roughly flat on growing earnings. So that should mean our ratios are improving over time, which is what we want to see. Market cap is shares outstanding times average price. Their fiscal year ends October, so I'm taking average share price in October. And again, we'll pick up kind of from this way, post-spin out. They spun out at $23 billion of equity market cap, which is super cheap. They've upped it to 36. It's a little higher now. The share price is running up after Buffett made his announcement. But it's $36 billion of value. If I add these two together, I get the enterprise value. Enterprise value, again, is the entire business. And we're going to measure the entire business against the entire business earnings, EBITDA. And I get a ratio here. I'm going to cover debt first, though. Net debt to EBITDA is our risk for bankruptcy. We want low debt as possible. Certainly in this rising interest rate environment, you do not want a company that's highly leveraged. High leverage is a risk of bankruptcy. Us, as common stock owners, we are in the very bottom of the capital stack. Capital stack is just the priority claim on assets in a court of law if the business were to go into bankruptcy. And the more people or institutions between you and the asset is a greater risk of bankruptcy. So we want as few institutions between us. This is a measure of the level of debt that is applied on the business, and it looks like it's only one time. So that means 1 year of earnings, right there, $5 billion, pays for all the debt. That's fantastic. If they had to, they can easily manage that debt and they could pay it off if they really chose to. That's what we want to see. That's a nice hallmark for safety for us being common stock owners. Next thing we want to do is look at valuation. I'm going to exclude this period because that's before they spun out. After they spun out, there's a clear difference here. They're trading at mid-single digit EBITDA multiples. That's a payback period. So again, if a business is generating $5 billion of annual, that's debt, sorry, let me go over. If the business is generating $5 billion of, or $4 to $5 billion of annual earnings, and I can buy the entire enterprise for $40 billion, then that's basically 10 times or 10 years required for the business to operate to pay itself. That's a low multiple. It just is, especially in this environment where the S&P 500 as a whole trades around 20 times. So to be able to pick up a business at half the value of the rest of the market, in my opinion, is a great starting point for an investment. You've got something that's got very low debt, growing revenue, growing earnings, and you're buying it at a very, very reasonable price. Frankly, 6, 7 times earnings is something you would pay for a much, much smaller business that was not public, did not have professional management, did not have the liquidity that this stock has. Now, there are reasons publicly traded companies trade for double-digit multiples and private companies trade for single-digit multiples. Oftentimes, it's a size premium, it's a liquidity premium, and it's a caliber of management that you can attract. And this, to me, a single-digit trading company at this size is an opportunity for value. So that's a quick rundown on the profitability. I like the low debt. I like the revenue growth. I like the EBITDA. Let's go check cash flow. Where the rubber meets the road, the main point of this channel, the main point you're an investor, is why you buy cash flowing assets. Let's go take a look at the cash flow statement. Okay, cash flow statement, right? The best, my favorite cash flow statement. Here we go. 2016 on, they did the split cash flow from operations. That's the first third of the cash flow statement. But I let the kind of the dust settle. Low point, $3.2 billion of cash flow. And that cash flow has grown pretty much every year to a high of 6.4. That's a 15% annualized growth rate when I look at just this section. Agreed, I kind of bottomed out and cherry picked a very, very low number. So maybe it's not going to run rate this out in the future. But I think certainly in this range, in the single digit growth period, there's a nice growth rate here for cash flow from operations. And again, cash flow from operations is the cash money that is generated from selling the computers, the printers, and so forth from the business. It's different from operating income. Operating income has non-cash charges in there, such as depreciation, has interest, which is not necessarily germane to the underlying business. It has legal or separation, M&A costs that could distort earnings a little bit. But cash is pure cash money. And an auditor can go to the bank of HP and say, hey bank, how much cash money did they have at the beginning of the year and at the end of the year? And the auditors double check that the performance of the business that the business is reporting reflects the change of cash year to year. That's one check the auditors will always do. And I like it because they can call a third party, in this analogy, JP Morgan is their treasury department. They would call JP Morgan and say, hey, JP Morgan, I'm the auditor for HP. I need to know their balance, cash balance in their checking account at the beginning of the year and at the end of the year. And JP Morgan say, here, auditor, here's all the statements, here you go. And they'll say, oh, great, you started here, you ended here. This is the business operation mid-year. It checks out. I can verify it, and they check the box. That's one check that the accounting does, and it's centered around the cash flow statement, and that's why it's so critically important that you always look at the cash flow statement of a business. Okay, enough of that. Let's keep going. The next thing I love about this business, now check this out, is this CAPEX. CAPEX is capital expenditure. It's an abbreviation. It just means the money that the cash HP puts back into their manufacturing facilities to be able to continue to generate the business that they do. So they're doing their thing. They got the sales team, they got a manufacturing team, and they're making computers or printers, what have you, and they sell them and they go out the door. Well, the equipment needs upgrading. It needs new conveyor belts. It needs new systems. It needs paint on the walls. Maybe they want to build an entire new line to make an entirely new product. All that is CAPEX. And that basically, it's a reinvestment that allows them to maintain their existing production capabilities and improve those efficiencies, scale. It's not an acquisition. If HP were to go buy Dell computers, that's a totally separate thing. This is just what's kind of required to keep the ball rolling. And what I like about it, and what you should like about it, and what you should see instantly if you've been watching this channel forever, is this delta. The difference between this number and this number is very, very small. CAPEX is roughly 10% of the cash flow that they generate annually. That means that 90% of this money goes right through to you and I, the common stock holder. That's what we're buying. That's what you buy when you buy a stock. You buy this here. And the value of the stock that trades in the stock market is everyone's forecast of what this number is going to be in the future. To round out this, you can also borrow money. Think of, back to the house analogy, if you paid 100% cash for your house many, many years ago, and it's appreciated in value, you want to go do something because you want to buy another house, you can borrow from your first house for the down payment in the second house. That is perfectly reasonable to do, and businesses can do the same. That's right here. And the reason we can include that cash as equity owners is because the debt in the business is so low that if they borrow while they're growing their earnings, it's perfectly acceptable to assume that is cash that is available for the common stock equity holders. That is dividending, that is buying back shares, totally fine. If, however, the business has too much debt, 3 times debt or more, no. You do not allow them to continue to use positive numbers in this thing as part of the free cash flow because they've exceeded the debt limit and you have to pay down the debt. So that's one caveat I use when I'm looking at stocks. And what I liked here is that in here, they borrowed some money and they could totally do that. And what they did is they bought back a lot of stock. Look at this. From when they split off, they have 1.9 billion shares outstanding. They have 1.2 billion now. That's a 7% annualized buyback. They're reaching in the stock market. They're paying market value for the stock, and they're tearing them up. And that means, like I have here in my little trifecta t-shirt, that means that all the pie that you own is getting bigger and bigger and bigger without you having to put another dime into the business. Your equity ownership of this business is growing over time without you having to invest more money. And that's fantastic. And not only is this is the equity ownership growing, but the business itself is also growing. So part of what I look for, part of what we look for in this channel is what I call the trifecta. The trifecta is a combination of 3 things that happen for a stock to really magnify the return that us as equity owners get. The trifecta, as I define it, earnings growth, EBITDA, which we saw is growing at 6% per year, share buyback, share buyback, what you're seeing here, where the pie that you own is getting bigger. And number 3 is market multiple expansion, basically the popularity of the stock. You buy something cheap at 7 times, and then in the future becomes more popular, and it trades at 10 times. This happened to Apple, by the way, which you could have purchased Apple at 7 times EBITDA. It's happened to Microsoft. It's happened to a lot of big companies. And what that does, those 3 things stack on top of it, and it produces a hockey stick curve that gets your return to be exponential. And it's how people like Warren Buffett have made absolute fortunes over the year. They sit back and they apply their cash to the companies that have the highest probability of beating the market. That's it. They make big concentrated bets. And this stock is doing that right now. So they're buying back stock. All this money passes through. I think the free cash flow per share, even with the debt that they borrowed, that's $5 to $7 billion of jack that they make every single year. Now, what's the market cap? Market cap, that's 26 to 36 billion annually. And cash flow is roughly $5 billion. That is a double-digit free cash flow yield. Let me get to that right now. So if I put the free cash flow here, divide by the number of shares, I get free cash flow per share. $3 to $5 a share. You could have purchased this stock at $18 or $30 the last couple years. It's now $40. Had you purchased it back then, you're making 20% cash on cash return. And well, they don't distribute. It's not quite cash on cash, but it's a 20% free cash flow yielding investment. Amazing. When I look at it today, right now with the stock at $40 a share, against that cash flow, no debt, not even including the debt, just cash flow operations minus CAPEX, it's yielding 12% free cash. If you include the debt payment that they think they can continue to borrow, it goes north from there. So that is a very, very strong cash flowing company. It's one of the reasons I wanted to wear the trifecta t-shirt today. Let's take a look and forecast this business and figure out how much we can make if we bought the company today, held the stock for 10 years, went off and lived our life, and just looked at the stock 10 years from now. Okay, let's forecast this business. Now, this is a guess. This is always a guess. It's math on paper. No one knows what's going to happen. Certainly, the pandemic taught everybody that nobody knows what's going on. But what we're starting with is a pretty good foundation, right? We've got growing revenue, growing earnings, low debt, strong free cash flow. That's a great starter point. Now what we're trying to do is figure out if it's well priced. And what we do is we build a conservative forecast, and then we see if the IRR is above market. If it is, and we think the conservative forecast is real, then it qualifies for further analysis. Let's keep going. So what I'm doing is I'm growing the EBITDA target by 6% year over year. That 6% is basically what they've been doing historically the last several years. I am picking up off the pre-COVID high and growing it. There's some risk there. But what I do is I reduce the growth forecast going forward, because who knows? The further out you go, the less visibility you have, the more unknown unknowns can affect the forecast, so I'm dropping the forecast. And what that does, it takes the forecast from $7 billion to basically $10 billion out 10 years. That's really what you're saying. I think this business is going to grow mildly. It could go up, it could go down. Basically, they need to hit $10 billion out a decade from now. And I gave a 10 times multiple to that because I think 7 is way, way too cheap for a business this size. So you got 10 times that. That's the last piece of the trifecta. You buy it at 8, it's currently traded 8 times. It grows to 10. That means every single dollar that they generate is worth more than it is today. 8 times to 10 times. So this is a $100 billion enterprise company, less some debt. I didn't have any cash outstanding on hand. I get a $90 billion market value. Divide by existing shares outstanding, I get $71.36 price target for HP out 10 years. Okay, let's forecast the free cash flow. Now, $5.06 is free cash flow growth with 6% year over year. Now, what I'm doing is I'm excluding the borrowing. This is just cash flow from operations, less CAPEX, grown at 6%. If I were to include the debt that they could continue to borrow, this number would be closer to $6, an extra dollar every single year, and your return would be even higher. So for conservative, I'm saying it's just cash flow from operations less CAPEX, and that grows to $7.10. And I apply a yield to that of 7%, which still has a high yield, very conservative, high yield 7%. It's currently yielding 12, so that the reduction, the 12 to 7, is a market multiple expansion, right? Market multiples go up, yields come down for growth stocks. So going from 12 to 7 is a reduction. I'm dividing this into this, so the stock price goes up. Inversely related. That gives me $100 share price out 10 years with no extra borrowing. So this number could be even higher if they borrow. Now we've got two estimates. We've got one based on the free cash flow method of $100 in one share, and another one based on enterprise value market multiple of $71. Now I want to make a comment here. I've split the difference here, $86. One comment on what Warren Buffett does, he does not use this value, right? He just uses the free cash flow method. In fact, he doesn't even apply a terminal value to it. He just simply takes the growth rate, runs it out into perpetuity, and then basically present values the whole thing. He does not assign a terminal value to it. And that's very interesting here because the free cash flow valuation is higher than the market multiple method. There's definitely strong cash flow here. Here's our IRR calculator. So we've got $5, which again could be higher if they continue to borrow to buy back shares or other things, but we're being conservative. I can buy as much stock as I want right now today at $40. And I think out 10 years from now, it's an $86 stock, 86 to 100, someplace in that range. And when I net those together and discount it back, I'm looking at a 23% IRR. Now, what's an IRR? Is an annual rate of return. That says that if you buy the stock today and this pans out, you would have received 23% interest on your invested money every single year for a decade, which is a very, very strong return in a world right now where most all stocks are wildly overpriced. Interest rates are going higher. The economy is coming off a stimulus high, so I think there's a lot of risk there. And there's a lot of global turbulence with what's going on in Europe right now. So if you look at all those in their totality and you find a stock that's trading, in my opinion, my only opinion for my personal vlog, cheaply, this is a very attractive risk-adjusted return. I will remind you the growth rate. The growth rate is low single digits. This is basically, right now, less than inflation. And it achieves a very, very strong return that is much better, in my opinion, than buying companies at high multiples, such as NVIDIA, such as Netflix, such as even Microsoft, as much as I like Microsoft, paying 20, 30, 50 times earnings, and then having a forecast that has double digits here every single year, 25%, 15%, 10% every year, is much, much harder than a business like, say, Intel, or a business like this that has to grow at a low single digits to produce a market-beating return. I think when I look at and read about how investing, like the Buffett way or the Buffett style, he makes large concentrated bets on stocks that have a high probability of outperforming. Nobody knows what's going to happen, but if the forecast is very, very low and it still outperforms, that seems an easier objective than setting the growth rate very, very high and having the same expected return on an apples-to-apples basis. So let me give you a distribution curve. If you like the stock or you're looking at this video 6 months from now and the stock price has moved, assuming everything I just went through in the math, behind me is just math, it's not a prediction, it's just math. Assuming that all pans out and the stock price, which is $40 today, moves up, I still think it's a very interesting buy up through $50, right? Very rarely are we seeing stocks right now with IRRs north of 17%. And I think you could buy the stock all the way to $50 and you're still expected to beat the market is a strong move. Conversely, if it falls, it's even better. The people who picked it up in the 20s and 30s, outstanding buy. Very kudos to you. So let's review our 5 key attributes. Number 1, top line revenue growth. Check the box, yes. Number 2, EBITDA, yes, check the box. Number 3, strong free cash flow, absolutely. Number 4, low debt, yes, 1 times. And number 5, well priced, yes, it is well priced because of the aforementioned growth curve. So this gets a good It also gets the trifecta t-shirt, which I believe it's exhibiting, and there's a strong possibility here that you can get the earnings growth, the continued share buyback, and the market multiple expansion if they catch a tailwind in the market, and you can see that exponential growth. All right, if you liked this presentation on HP, I encourage you to visit my website, cashflowinvestingpro.com, where I teach a course on investing, and I give you this financial model. I teach you how to read 10Ks and how to extract revenue, cash flow, CAPEX, talk about interest and debt payment, talk about working capital, how to read a balance sheet, and then how to build a forecast that's conservative. And what you do is by going through these stocks and looking at these forecasts, you will gain knowledge on what the market can offer you, and that perspective will help you build a focused portfolio of a handful, 20 or 30 stocks that you know well and that will hopefully beat the market. That's the idea. Right? If you look at the S&P 500, the index, there's 500 stocks in that index. All you need to do is pick 10% of them that have a probability of beating the market and hold them for a decade. And a simple screen tool, a little forethought, focusing on businesses, industries that you know well, you should be able to pick out stocks with a high probability of beating the market if you held them for 10 years. That's the objective of the Cash Flow Securities Club, is to teach you to do that. Now, if you don't have time to do that, but still like this, I would encourage you to check out the Cash Flow Club. Now, follow a link down below in the description for the Cash Flow Club or the investment course, but I produce one-pagers on a whole host of companies that I don't have time to review online or to make videos. And as I'm doing that, I give you 10 years of historical financial reviews of everything I just did, a forecast, a summary of how I built the forecast, and you can judge for yourself. If you like the forecast, buy the stock. If not, don't buy the stock. But that is going to teach you. And if you go to the website, cashflowinvestingpro.com, or follow the link below, you can download for free some sample reports of the cash flow one-pager. And I highly encourage you to do that. All right. Thank you very much for watching this review on Hewlett-Packard HP. Up now are going to pop up a couple of videos of some other value stocks that I have reviewed. Check them out. I really appreciate it. Give me a thumbs up on the video. Throw a comment down below. Let me know what stock you'd like to see next. I'm happy to take those recommendations. And always, please hit the subscribe button. Really do help. They're trying to grow the channel. Thank you very much again for watching this review on HP. Have a good day. Bye-bye.